MoneyWise Wednesday. Today we are talking about understanding and improving your credit scores. The big topic, isn't it, guys?
Indeed.
Yeah, so if you've ever come to one of our live workshops, you've probably seen this is one of the most well-attended workshops that we do. A lot of folks want to hear about what's the secret behind FICO scores, right? And we want you to know it's not a big secret. We don't want it to be a big secret at all. So before we jump in, I just want to share real quick with you guys that today our drawing is going to be for those for a gift card for those who like and share this video on their personal pages. So be sure to like and share, and you're going to be entered to win a $25 Visa gift card from us. We're going to draw a winner on Friday, and want to do a special shout out to last week's winners. They are Ursula Smith and Shamika Carlisle. So congratulations to you too. Very nice. And don't forget, we also do monthly drawings on our MoneyWise playlist. So we're going to show you where to go to find that. So make sure that you go to MoneyWise, complete a playlist, and you're automatically entered to win. All right. So I've got my friends Herschel and Kelly here with me. Hey guys, welcome back. And we're going to just dive right in. So credit scores, let's start talking about it. Kelly, you want to go first?
Sure. A few weeks ago, we talked about debt management in one of our previous sessions, and we shared some information regarding the types of debt that consumers have. In the United States, we have a little over $14 trillion worth of debt, and that's consumers. That's not the government, that's us. And out of that, about $9 trillion is mortgages. The rest of it is HELOCs, auto loans, student debt. And student debt is the largest rising debt that we have right now. So it's a combination of those along with credit cards and things like that. So $14 trillion in debt, just the consumers. So your credit can have a big impact on your financial life, and credit scores and reports provide just a snapshot of the financial habits that you have. To institutions, to cell phone companies, credit card companies, anybody that you would get credit from looks at that information. And they use it to get a sense of your credit worthiness. So if your credit is not that great, it's going to affect you in every aspect of your financial life. Yeah,
very good. Herschel?
Yeah. So understanding how your credit scores and credit reports work can help you achieve financial goals, such as buying a home, leasing that new car that you often look forward to when you're driving down the road, paying off debt, right? Being debt free. As of right now, amid all the uncertainty of our economy and our personal finances, it's important for you to understand how the decisions that you are making today may impact your credit score. Guys, join us on this journey. This conversation is very important. Let's take you there.
Yeah, we're really excited to talk to you about this today. You know, I just want to pause for just a minute because some of you guys might be watching this and, you know, you may be in a place of just kind of bracing yourself. I think we're all just kind of bracing ourselves for the unknown, right? And I think it's really important that we take a look at credit scores, not because we want to prepare, well, we do want to prepare you for your credit worthiness as far as we want you to have more borrowing power. But on the flip side of that, we also want you to kind of understand that we know and we understand that you may have to make some very critical decisions in regards to some of your debt right now for things that are going on. So I think it's really important, and we really felt the urge to really make sure that we talk about this topic, because sometimes you may find yourself having to make a choice and having to choose between, do I not make a payment on this and fall delinquent on it in order to do these other things, or vice versa? You know, I think it's important that you know kind of what the effects are going to be of each decision that you make, regardless of what you make. We're not here to tell you if it's the right or wrong decision. We just want to make sure that we educate you to know what's going to happen if I choose to default on that loan, or what happens if I choose to not pay it right away and pay it in 60 days or so. And to know that there are credit score impacts. There are definitely some effects that are going to take place on your credit score And so we want you to look down the road. We want you to try as hard as you can. We know you can't predict the future. None of us have a crystal ball on our desk. Man, do we wish we did right now. But we want you to know what the impacts of some of those decisions that you might be making will have on your credit score. So it's really totally informational. If there's something personal to you that you really want to chat with one of us about, we really encourage you to reach out to us personally, and we can go on that. We want to walk alongside of you during that journey. We're here to help you, and there's other tools that you can use as well. So anyways, reach out if you want by email. You can email our team directly at community@envisioncu.com, and it comes directly to all of our inboxes, and we'll be able to take a look at it and reach out to you personally and answer any specific questions that you might have. So I just kind of wanted to preface with that, because yes, it's a heavy topic. It's an important topic, and we want you to be credit worthy. But we also know not everybody's running out right now buying cars and boats and houses. A lot of people are kind of on pause. But what happens if there is a negative impact due to COVID-19 in my finances? How could that also keep me from being as credit worthy and had this not ever happened at all? So that's kind of why we're going here today, okay? It's a long way to say what I wanted to say, but I think you're getting it. Okay, so let's go. First, I think the very first step to really understanding how to increase your credit score is first to kind of know what makes your credit score, right? Like what makes my credit score what it is. So this is what we call the Beacon Roadmap, okay? So, yep, that's right. Which road to choose? Have you ever found yourselves like literally like having to choose? It seems figurative, with the whole like fork in the road, but I can look back on my life and think of so many financial scenarios where we had to choose, are we gonna do this or are we gonna do this? And then where is that path going to take us? So, so first, I think it's really important that we take what really makes up a score. Let me zoom in here for us a little bit. All right. So first, I think it's important for you to understand what is a credit score tier. Okay. Now, this is what we operate on at the credit union. Okay. So these are our tiers, but some banks, some credit unions might vary, but they're all pretty darn close. In range, right? So A plus credit is going to be a 730 credit score or above. Some are 720. We're at 730. That's going to be A plus. 680 to 729 is A credit. 640 to 679 is B credit, so on and so forth. So you kind of see. So if you know what your credit score is, then you kind of know where you fall in this. And listen, sometimes, Herschel, let me just ask you, when you teach this workshop and when you first go through this part, you can tell by the looks on people's faces if they are happy or unhappy with what their score is based on this, right?
Absolutely. It's like, I compare this to a lot of like students in class with a professor or a teacher, right? So you can tell the students that are prepared by studying for the test, right? That have put in the time, taken notes and did the study share groups, and they're ready for the big test, right? Because they get the 8, right? Just like in our world, our credit scores are just like in the classroom. If you pay your bills on time, you get a good grade, right? Right? You don't overextend yourself or stay up late partying. You apply yourself, you get a good grade. It's just like credit in the real world for adults. It's just like a student setting for kids.
Yeah. Yeah, you can see like some people kind of like will just put their heads down. Some people will be like, oh my gosh, why am I here facing the music, but I always say, you know what, if you've made it this far and you have a cheek in the seat, or for those of you plugging in online to talk about this topic, you're already one step ahead and one step closer to achieving the credit score that would make you proud, right? So we want to give you encouragement. So this is not to classify you or to put you in a box or to make you feel, unworthy or unaccomplished, or for those of you who have really great credit, this isn't to boost you guys up and to, give you a pat on the back. Although if you've gotten there, great, that's wonderful. But what can you do to continue to maintain that, right? Or what decisions or choices or actions can you make that could hurt you? Like, we want you to know what those things are. So, so what makes up your credit score? This is the most informative part, this and one other section that we'll do right after this. But the most impactful part of your credit score is going to be based on payment history. So if you see right here, 35% of your credit score is simply based on do I pay on time? That's really it, on-time payments. And, you know, most people think that as long as they pay on time, nothing else matters, that they're going to have a credit. You know, oftentimes I'll have people come to me and go, I never pay late, but I cannot get to A credit, right? Or I cannot get to B credit to get the promo auto rate. Like, what is going on? And I have to tell people that payment history is only 35% of your score. What about the other 65%? Okay, so the other 65% is made up of, the next highest one is capacity. We like to say capacity is king. So capacity, Herschel, can you like real quickly explain what capacity is?
Yeah, capacity, just exchange that word, Kelly, for our viewers, for usage, right? So when we say capacity, you say usage. So if I've got a $500 credit card and I've used 250 of that $500 credit card, I've used 50% of the capacity. But in real, unlike wordy terms, I've used only half of it, or I've used 50% of it, or rather than capacity. So exchange the word capacity for usage, simple terms.
Perfect, exactly. And then you'll see the other 35% here is a combination of your length of credit, which carries about a 15% weight, the accumulation of debt in the last 12 to 18 months, which also includes number of inquiries and opening dates, that's about 10%. And then the final one is mix of credit. Now you'll notice here with mix of credit, there's two different subtopics here. You have installment and revolving credit lines here. Kelly, can you quickly explain to us what the difference between an installment loan and a revolving loan is?
Sure. So an installment loan is a loan like a mortgage, a car payment, a boat payment, anything that's got some type of collateral attached to it, where you start out with a set dollar amount and you pay it down until it's paid off. That's an installment loan. Mm-hmm. Revolving credit is a line of credit that you pay down and you can charge right back up, like a credit card, a personal line of credit. So you have the ability to pay it down, but then you have the ability to charge it right back up again. So it revolves. Yeah.
So think about like a revolving door at the front of a hotel, right? It continues to go. It doesn't stop unless they lock the doors at night, right? And they put the stopper in the bottom, right? But it continues to revolve around. You can walk in it, you can walk out of it, right? Same thing with revolving trade lines is I can borrow from it, pay it back, borrow from it some more until the trade line is closed out. Hopefully, if it's closed out, it's by your terms and not because it got shut down by the lender, right? Or the lender. Also, just to clarify something real quick on installment loans, you can have an installment loan that does not have collateral tied to it, but it is most common to have trade lines of installment loans that have some sort of collateral. So it kind of helps people understand what the differences are. But there are some installment loans out there that don't have collateral tied to them, but that doesn't mean that they're still not risky loans, because they certainly can be risky loans, right? So, you know, this kind of gives you an idea of what makes up, you know, that whole score for you, and how it's kind of easy. I like to tell people when they say, well, what's the first step in me kind of understanding in my own personal financial life why my score is what it is? The first thing I always tell them to do is go get all your statements and put them all in one place. Go get a list, create a list of who do I owe, what's my minimum payment, what's my balance, what's my interest rate, what's my limit, right? Because when you know the answer to all of those things and you look at them one at a time, it's kind of clear. It becomes more clear to you when you can see individually all those trade lines, how that particular trade line may be affecting your score positively or negatively. So I like to tell people the first step is you take a look at the individual trade lines and let's see. With installment debt, maybe take a look at how new is that loan? So how far away are you in making those payments from the original balance amount, right? So like a car loan would be a great example. And we talk about this a little bit in our kids session from the 10 o'clock this morning. It's like, you know, capacity is still important when you're talking about installment loans, but we don't want you to get confused. Like, really just take a look at my overall debt. How much do I owe in overall balances? And then what are my limits available to me, right? And so, of course, capacity is going to really have a heavy bearing on a lot of people. A lot of people, that's the big missing link, right? I know Herschel hears this all the time. They don't even think about usage. They don't think about capacity. They just think, but I pay it on time and I've had it. Right. So you've had it for a long time, which is great, but you're maxed out on it, right? So it's really not helping you that much. It's actually the heavy weight that's holding you down. It's like it's the ball on the chain that you can't seem to get away from.
Indeed.
So I think after hearing some of that, I think it's probably a little bit of common sense of what actions could hurt our score, but let's not assume here. We'll just kind of go through. Obviously missing payments, right? If that has the heaviest bearing on your score, that's going to hurt you. Maxing out those credit cards, or even being over 50%. We like to say about 50%. 30% is really ideal though. And here's why, guys, think about it. Let's say that you do want to go out and get a loan for something, whether you feel like you're forced to because of the scenario to, you know, whatever that you're in right now, or maybe there's a new car that you want or whatever, right? But you're over 50% on all of your credit cards. Do you think that you're going to look less risky or more risky to a lender, right? Herschel, I mean, that's what we do, right? We're taking a look at what is their credit worthiness? How risky are they looking? Because we're also thinking about what happens if you lose your job? What happens if someone gets sick? What happens if coronavirus hits, you know, and your hours get cut?
Yes, you're right. So a lot of lenders, Kelly, look at like a two-pronged approach, right? The ability to repay and the intent to repay, right? So we look at your intentions by looking at your history of how you paid other lenders that you borrowed from. That's your intent. Do you intend to pay us, right? The second prong, the other prong that's pretty powerful, is the ability. Where's the money? Show me the money. Do you have the ability to take on new debt? Can you repay this loan, right? Those are significant factors whenever we're looking at giving money, based on whether or not you have the ability to repay and the intention to repay.
Right. Absolutely. Yeah, absolutely. And, you know, hear this. If you're watching this, hear this. If you've been a longtime member of Envision, it's really important that you know that every new loan request is its own standalone thing. Your relationship with us matters. Your relationship with us says volumes about you know, the future of your credit worthiness and stuff with us. But we also have to look at the snapshot of where you are right now and what has led up to this point, right? And so a lot of times we'll hear people say, and I know I have friends who maybe bank elsewhere that are like, I don't understand why I didn't get approved for a loan because they always have approved me. Okay, well, what happened between then and now that changed for me? Was it income level? Was it my debt to income? That's huge, guys. Debt to income is huge. Most Americans are spending over 50% of their income on their mortgage and rent. Okay. A healthy number is between 25 and 30%. And we're spending over 50. So that right there, like, there's just little things that you just got to look at, you know. And so, you know, Herschel's right on. We're looking at not only do we think you can pay, but do we think you intend to pay, right? And if you might have intention but not ability, right? So you may want to pay us and you may say you're going to pay us, but history is kind of showing otherwise, especially in the event of an emergency or an unforeseen circumstance, right? It makes you a lot riskier. Okay, so opening up numerous trade lines in a short time frame. This is really big for young people who are discovering that they have a credit score, and then they see that it's good and they go, oh wow, I have a B credit score, this is great. And then they go open up all these retail cards. You guys are laughing because it's true, we see it all the time, right? No. They get the free eyeglass or the free sunglasses or the free beach towel or whatever, and you know, or they get their 25% off today's purchase, and they get a, 25% interest rate on that $200 credit card that they're now maxed out on. So anyways, just going to leave that one right there. And then maybe having more revolving debts in relation to installment debts. Remember, we talked about mix of credit up there. So mix of credit shows that you can manage both types of loans, very helpfully, for a lack of a better word, right? So if you show that you have a lot of revolving debt, not any installment debt, that's super duper risky, because a lot of times revolving trade lines are not tied to collateral. So if you default on those loans, or if something happens, those lenders cannot take back any collateral from you to recover some of their costs, right? So that is also something to be very mindful of. A lot of people might go, but I don't need an auto loan. I don't need a new car. I don't need to go get a unsecured installment loan. I don't need anything. Okay, well, maybe you can get an installment loan to pay off those higher interest revolving trade lines to help bring that capacity back to where it needs to be, so that you are healthy and less risky. And you can tie collateral to it if you want to. Maybe you do have a car that you have the title on, right? Or maybe a home equity would be, if you have equity in your home, that's an option. It's not for everybody, but it might be a good solution to help you bring that revolving trade line down a bit, show that you're less risky, right? And then at the same time, it's increasing your credit score all at the same time. So in the event there is a future purchase that you might want to make or something like that, you have a little bit more of a borrowing power in that sense, and you might get a better interest rate because you have the better credit score. All right, so I'm going to jump down here to approximate credit weight for each year. This is almost, to me, as enlightening as just knowing what makes up your credit score. This is also really huge, one of those best kept secrets that we don't want it to be a secret for you. 40% of today's credit score is made up of the most recent 12 months of credit activity. That makes sense? Let me say it again. 40% of today's credit score is made up of the most recent 12 months of activity. Okay? And it drops down by a 10% weight for basically every year after that. Okay? So activity within 24 months has a 30% weight on today's score. Activity within 3 years has a 20% weight on today's score. Here's the other kicker. Activity beyond 3 years has 10% or less on today's score. So a common question that we often get will be, okay, so Kelly, I did a bad thing a couple of years ago, and I had a repossession. And I owed $1,500. My car was taken away, but I never paid the $1,500 back. Should I pay it back? Ooh, that's a heavy question, because we don't go, yes, you should, no, you shouldn't. Our job is to go, well, let's talk about that. So the first question I usually ask is, how long ago was that? If it's within the 3 to 7 years, I typically ask them this: do you want the monkey off your back, so to speak, and you just want to be a good person and you want to follow through with the commitment that you made when you signed that dotted line saying, I will repay this loan back to you, and you want to make it right? Do you want your credit score to increase, and are you expecting your credit score to increase? And then if they say, well, all of the above, then I say, great. If you want to be a person of your word and you want to pay that loan back and be in good standing with that lender, then you need to pay it. Get it off your chest. Make it right. But it's going to have less than a 10% bearing on today's score. So it's probably not going to increase your score, but it's certainly going to show on your credit report that you made right with the borrower or with the lender, right? And you followed through with your commitment even after the vehicle was repossessed. So personal choice, right? If you have a personal relationship with your lender or your financial institution, like our members do, like you guys do with us, we take that into consideration very, very strongly, do we not? Like Herschel's like, pumping his fist over here because he knows, like, we know that life happens, guys. We know that people lose their jobs. We know that people make bad choices. There's no guarantees that we can always say yes, right? But when we can see your track record on your report card, which is your report, credit report, when we can see that you have made an effort to right the wrongs, we will do pretty much what we can within reason. We will try the best that we can, and that's why Kelly has said before in the past, in the debt management one, just talk to your lender. Don't avoid your lender. If there's a situation or a crisis or a life situation you're going through, just talk to us, because we can see that history of communication with us or lack thereof in your history with us. So just talk to us. You just never know. Kelly, do you want to add anything to that?
I think that you said it the best. If you communicate with your lender, they're more willing to do things. I mean, we've had members reach out to us that just looking at their credit snapshot isn't the greatest. However, we look at their credit and their history with the credit union, and we'll do things for them that we won't do for other people, because you've shown us that you value your relationship with the credit union. So, it's people helping people, and we're member owned, and that's what we do. So stay in touch with your lender. It's not going to go away. So talk with us. And a lot of times we can come up with a solution that you never even thought of, and it's something that you can do. So it doesn't happen until you reach out to us and talk to us.
Yeah, really good point. Now, if you'll notice, I know I'm jumping around here. I'm sorry. This is welcome to Kelly's world. But if you look right here, it says an action that can hurt your credit score is closing credit cards out. This could lower your available capacity. Herschel, I would really appreciate if you could talk to that a little bit, because oftentimes I know you and I hear questions, and Kelly hears questions from people saying, well, I've had problems with the credit cards in the past. I've paid them all off, and now I want to close them out so that they're not there as a temptation anymore. Why could that be a potential, action that could hurt your score?
Yeah, so whenever you're closing credit cards, remember, part of that is the actual capacity piece that you have as a full play. So for instance, let's say you had one credit card for $1,000. You had another credit card for $2,000. Combined together, that's $3,000 overall limit. Would you agree?
Yep.
I charge $500 on one of those cards. That would take me into using some of the capacity that I've had stored by limit. Remember, we've got two cards, one for $1,000, one for $2,000, which gives me $3,000 worth of credit card limit. If I use 500 of that, I'm nowhere near impacting my score, because I'm so far away from 3,000 that nobody sees that as a risk. I don't stink to the creditors. I don't seem risky. I don't seem like they need to come and give me letters or send me notices, right? I'm not scary to them. Now, imagine if I close out that $2,000 credit card now, Kelly. I just closed it out, right? Now I only got one card with $1,000. Now that $500 that I had is compared to that $1,000 limit now. Now smell risk. That's why it's important to manage how you close out your credit cards and work with a financial consultant to make sure you're doing it the right way.
Exactly. Really, really good way to explain it. It's just, and it's going to take you, and think about it, over time, your score is going to start potentially trending downward a bit, depending on the other mix of credit that you might have out there. But just from a general example standpoint that we just did, over time, that's going to trend your score downward a bit, and we're going in the total opposite direction of what you're really wanting to accomplish. So just something to keep in mind, to be really careful of. All right, so I want to show you guys, we're not going to go through it today, but I want to show you at home, because we've been talking about our MoneyWise platform. I want to show you where to go to see our playlist. And don't forget, you're entered to win a $100 gift card for every playlist you complete. So I want to show you where to go to do that. MoneyWise website, envisioncu.com/MoneyWise. And you can click on Start MoneyWise here, go on over, and it is under Building Financial Capability is one of the playlists right here. And it is just the third one down, Credit Scores and Reports. So at the beginning of the playlist, it has just some basics to kind of get you started. And then it walks you through a lot of what we talked about already. What is a credit score? You can watch a video here that kind of explains it as well, what the impact is on your life, shows you what the ranges are, like we've already discussed. And then over here, if you look at the left menu, do you know what your credit score is? How do you get your credit report? What's included on my credit report? What determines my score? So breaks that down a little bit. 7 actions to improve your score, and then some other key points and next steps to take away from. There are some personalized sections in here as well. So the way I might answer might be different than what Herschel or Kelly would answer. So I really encourage you to take some time to go here to explore some more education and get entered to win that $100 Visa gift card that we do. So I hope that this has really been an opportunity for you to kind of understand you know, what makes the credit score and some things that you can start doing, some practical next steps for you.
It's the second most single important set of numbers outside of your Social Security number. It's important for you to protect it just as much as you protect that set of numbers. If you need help, we encourage you to visit our website or reach out to one of our financial partners for assistance moving forward. We challenge you to get in control today.
So that's it for today. Next week, Herschel is going to be driving the train, and we're going to be talking about what's our big topic, Herschel?
I'm so excited. Predatory lending, one of the most often used avenues to overcome a hardship when it's really creating even more of a hardship. Guys, I'm so excited about this topic. I look forward to chatting with you next week.
Yeah. Even if you think that you would not fall victim to predatory lending, you need to show up for this, because you will be shocked how much predatory things are out there in the world, especially right now. So that's it for today. Thank you guys for joining us. We'll see you next week for predatory lending. Have a fantastic week. Don't forget to like and share to be entered to win. Bye.